In this video, we are going to take a look at the basics of currency options. A currency option is a contract between a buyer and a seller. The buyer of the option gets the right to buy or sell a fixed amount of the underlying currency at a predetermined price on or before the expiration date. The buyer of the option is not obligated to buy or sell the underlying currency. The buyer will only do so when it's profitable. Let's take a look at some important elements or aspects of a currency option. The first element is the price of the option, also known as the premium. This is the price that the buyer pays the seller. The second element is the predetermined price, also known as the strike price or the exercise price. The third element is the spot rate or the market price of the currency. And the last element is the expiration date of the contract. If the buyer of the option does not exercise the option by the expiration date, the buyer loses the premium and the seller keeps the premium. Let's take a look at basic types of currency options. There are two basic types of currency options. A call option that allows the buyer of the contract to buy the underlying currency at the strike price or the exercise price. The buyer of a call option is expecting the spot price to rise and the seller is expecting the spot price to fall. The buyer will exercise the call option when the spot price is above the strike price. That way, the buyer is able to buy the currency at a price that is lower than the market price. A put option, on the other hand, allows the buyer of the contract to sell the underlying currency at the strike price or the exercise price. The buyer is expecting the spot price to fall and the seller is expecting the spot price to rise. The buyer will exercise the put option when the spot price is below the strike price. That way, the buyer is able to sell the currency at a price higher than the market price. Let's take a look at a couple of examples. Let's take a look at the call option first on British pounds. The strike price is 160 per British pound and the call premium is 2 cents. This option will be exercised when the spot price is above the strike price. We are going to plot the spot price along the x-axis and we are going to plot the profit or loss at expiration along the y-axis. At the spot price of 160, both the spot price and the strike price are the same. At this point, the option is known as at the money option. This option will not be exercised by the buyer, so the buyer loses 2 cents. At 158, the buyer is not going to exercise and again loses 2 cents. And this occurs for all prices below 158 as well. So we have the following situation for the buyer. This option is out of the money for the prices below 160. When you stand to lose money by exercising the option, that option is out of the money. At $1.62, the spot price is higher than the strike price. So the buyer will exercise the option. The payout is going to be 162 minus 160, which is the strike price. So the payout is going to be 2 cents, but the net profit after you take into consideration the premium is going to be 0. So 162 is the break-even price. For a call option, therefore the break-even price equals the strike price plus the premium. At 164, the payout is going to be 4 cents, but after applying 2 cents towards the premium, the net profit is 2 cents. So we have the dot representing the 2-cent profit at 164. At 166, the profit is going to be 4 cents. At 168, the profit is going to be 6 cents. So we have a line that looks like this. Maximum possible gain for the buyer is unlimited, and the maximum possible loss for the buyer is only 2 cents, which is the premium. The option is in the money for the prices of above 160. The seller's position is completely opposite. This is therefore a zero-sum game. Anytime the buyer is making money, the seller is losing money, and vice versa. What about the spot price of 161? Should the buyer exercise the option? The answer is yes. The spot price is greater than the strike price, so the buyer should exercise the option, and by doing so, the buyer is cutting the loss from 2 cents to 1 cent. Let's take a look at an example of a put option. For simplicity, we are going to assume that the premium for the put option is also 2 cents, although in reality it would be different. This option will be exercised when the spot price is going to be lower than the strike price. Again, we are going to plot the spot price along the x-axis and the profit or loss at expiration along the y-axis. At 160, this option is at the money because the spot price and the strike price are the same. So there's a loss of 2 cents. The buyer will not exercise it. At 162, the spot price is above the strike price. So the buyer will not exercise, and there's a loss of 2 cents. For all prices above 162, therefore, the buyer will not exercise and will lose the premium of 2 cents. This option is out of the money for the prices of above 160. What about the price of 158? Well, now the payout is going to be 160 minus 158. That is the 2 cents. Remember, this time the buyer is selling the option at 160. The market price is 158. So the profit is 2 cents, but the net profit after taking into account the premium is 0. So 158 for the put option is the break-even price. For a put option, therefore, the break-even price equals strike price minus the premium. For the spot price of 156, the payout is 4 cents. 2 cents is applied towards the premium, and therefore the net profit is 2 cents. At 154, the net profit is 4 cents. At 152, the net profit is going to be 6 cents. The maximum possible gain here is going to be $1.58 because the lowest that the British pound can drop to theoretically is 0. So the maximum payout will be 160, and if you subtract the 2-cent premium, then the maximum possible gain is going to be 158. And again, the maximum possible loss is going to be 2 cents, which is the premium. This option is in the money for the spot prices of below 160. The seller's position is exactly opposite of the buyer's position. The seller loses money when the buyer is making money, and vice versa. What about the price, the spot price of 159? Should the buyer exercise the option? The answer is yes, because the loss will be cut from 2 cents to 1 cent. Couple of important notes here. An American option can be exercised on or before the expiration date. A European option can only be exercised on the expiration date. An option may be sold in the market instead of exercising it. In summary, the buyer of the option has the right but not the obligation to exercise the option. A call option would be exercised when the spot price is above the strike price. A put option would be exercised when the spot price is below the strike price. Thanks for watching this video. I hope you found it useful.